Michael. Hi, Michael. Can you hear me?
Hi.
Hi, how are you?
How are you?
Good, thank you. I'm glad it worked. Oop.
Great. How are you? Let me adjust this.
Okay.
Good.
Good.
Yeah.
Yeah, sorry about that. We all have IDs, but this ID was this meeting was created under Shannon's ID, and she was still having another meeting, but she's done now, so she'll be joining us momentarily.
Not a problem at all. Not a problem at all. I just wanted to go over the logistics of screen sharing and whatnot.
Yes, very good.
Because I don't want to find myself in a pickle in any way whatsoever.
Yes.
So show me what you want me to do.
Yes, so usually it will let me make you the co-host so that I can continue letting people in from the waiting room, because I don't want you to have to worry about that. But the only option right now is to make you the actual host. So
Okay.
I think once I'm gonna go ahead and just make you the host so we can practice it.
Okay.
But let me see if it's gonna let me still see who's in the waiting room.
Okay.
I think what it's going to do is it's going to give Shannon that right. So she might have to manage the waiting room.
Okay.
Okay, but right now at the bottom of your screen, you should see a couple of options. First, if you click on participants, and that will open a side window. Do you see an option that says participants?
Yep.
Okay, so now you can see like a white panel over to the right, and that's where, if there's someone in the waiting room, that's where it would tell you, like it will say someone's in a waiting room and admit them or reject them or whatever.
Okay.
And then next to participants is chat and then share screen. So if you click on share screen, that will open up, that'll show you all of the different windows that you can choose from. So you should be able to click on the one that has your PowerPoint.
Yeah, I've got like 8 windows open.
Yeah.
So
in whichever one you pick, you just double click on it, and there you go.
That?
So
is that working?
So it does. I see Wells Fargo Advisor PowerPoint.
So if I click on that.
Yep.
Come on now.
Yep. So
what does that do for you?
Now I can see it's a black screen with the current slide and the next slide, and that's fine. I'm wondering, just so it can make it larger, I wonder if just staying on either this page might actually be better if you, maybe zoom in. What do you think?
It's fine to me.
Yeah, I think that'd be fine.
I just want to make sure it's in, why don't we do it in,
yeah, maybe try a different view.
Slide master.
Okay.
No.
Oh yeah, there's the option, close, go back to slide. Yeah, over to the right, there's a close master view.
There we go.
Well, let's try, if you click on share screen again, I wonder, do you see, is there another screen that has the PowerPoint bigger?
I have two monitors.
Okay, because I think what you did earlier, where it was the black screen, honestly, I think this is fine, just this view.
You think so?
Yeah, I think it's okay.
Here's what the black screen looks like again.
Okay.
Go.
Mm-hmm.
Now if I share again.
Maybe this view is better, because then you don't see.
About this.
Oh, there we go. That's perfect. How did you do that? That's perfect.
I clicked on another one.
Okay. Great. Yeah, let's do that one. That looks great.
I'm gonna add Catherine.
Okay.
Amanda, Catherine is my partner.
Awesome. All right.
I see that we're recording.
Yes, I should have told you that. And I can send you the recording link afterwards if you'd like.
Yeah, okay, that's fine.
Mhm. Yeah, sometimes Shannon will get an email after the fact. I didn't get to see the webinar. Can you send me a link? And so
Yeah.
we like to record it.
Okay. Catherine, are you there?
Yes.
So,
Can you hear me?
hi,
Hi.
how are you?
I'm good. How are you?
Good, this is Amanda.
Hi,
Hi,
Amanda.
Catherine.
I'm Catherine.
Hi, good to meet
Amanda
you.
works with Jonathan and Shannon at Badger CPA.
Great to
And,
meet you. I'm sorry I don't have a camera on this thing, or at least I don't know how to use it.
Okay, no problem.
So basically, Catherine, Amanda is going to be our moderator host person today.
Okay.
And I'll just run through the weathering market volatility PDF that we provided everybody. And
Okay.
I'm gonna, can you see it on the screen right now, Catherine?
Yes, I can.
How does that look to you?
Perfect.
Okay, so if I scroll down, hang on, do your job. There. Is that
Yes.
working for you?
It scrolled.
Yep, it changed the
Okay.
slide.
And can you see everything appropriately? Everything looks good?
Yeah, the size looks good. Yeah.
Okay, great. So what I will do is end that for now. Stop my screen share.
Yes. And don't show client screens.
Yeah, no, I don't want to. You know what I'm gonna do?
One of them popped up just now, so.
I know, I'm gonna shut down SmartStation
Yeah, that might be a good idea.
so that I don't accidentally do that.
Yeah.
And I'm just gonna sit back, and if you need me, holler at me or whatever.
Yeah, that's perfect.
At this point, my only concern is that I don't have co-host privileges, so I'm not able to let people in the waiting room. But I'm hoping that when Shannon joins, that she will be able to do that because this is her Zoom ID. So once she joins, I'll just make sure because we don't want someone to be left in the waiting room and not notice.
Right.
What's the waiting room?
Well, so we have a waiting room because this meeting is actually advertised on Facebook and different social media. And we, a few months ago, had an incident where somebody joined that was not wanted to be a part of. Basically, there was a situation that we regretted not having a waiting room. So
Okay.
a waiting room is basically, it gives me the opportunity to say, okay, do I know this person? Do I not know this person?
Very
Just
nice.
to make sure everybody's, appropriate.
Okay.
So
That sounds great.
yeah.
All right, so I think that I have eliminated all the other possible distractions here. And now if I want to share my screen, I'm sharing this. No, I'm sharing this. And I click share. How's that?
Perfect.
Perfect.
There's Shannon.
Okay.
How's it going?
Hi, Shannon.
I have a barking dog, so I am thinking I might go let him
Hey, Shannon.
outside.
Cat-
What are you doing? How's your
Catherine's with
family?
us. Mine, oh, everybody's great. Catherine's with us too, but she doesn't have a video camera on her portable computer,
No problem.
so we can't see her pretty face.
And Shannon, right now, only Michael is the host. So I'm wondering if you have co-host privileges because that option was not given to me. I think because it's under your ID. So basically people in the waiting room, I can't let them in. Do you?
Can Michael make you a host?
Yeah, Michael, if you if you click on participants, that button
Yes.
at the bottom, and then do you see Amanda Owens? And then when you hover over my name, there's a more button.
There you go.
Okay, see, but now I'm the host, which means you can't share your screen.
Why don't you switch it back to me when you're ready?
Perfect. Well, but if somebody joins like halfway through.
I wonder why it's not letting us do co-host. Let me go into my Zoom settings because maybe.
Okay, maybe there's a setting.
Maybe it's something like in the meeting. So let me
Mhm.
see if I need to go change this setting. 1 second.
Okay.
You guys hear my dog barking? Because if you can't hear it, then I'll leave,
No,
leave it.
not at all.
I think these days people are used to barking dogs periodically in Zoom meetings.
it's
I have
funny,
notes. I have notes, by the way. So I'm going to be trying to read like this as best I can.
It won't let me edit the meeting. So what'll happen, Michael, when you're sharing, why don't we let Amanda stay the host while we're letting everybody in? But when you're sharing, you might get a notification that there's somebody in the waiting room, and unfortunately you'll have to admit them. I don't think that many people will come in after the first few minutes, so I don't think it'll be a huge issue. But so why don't we keep Amanda the host like the first maybe 5 minutes when we just kind of introduce everybody, and then we'll transfer it to you when you're ready to share your screen.
No problem. That sounds great.
Hi, Nancy. Hi, Margaret.
Hi there. Good afternoon, everybody.
Good to see you. I'm glad you could
Nice
join
to
us.
see you too. I've been running around like a chicken without a head, so I'm like, it's 12. It's 12.
I'm gonna we'll probably wait until maybe 12:03 or so, and then Michael, you can introduce yourself and share a little bit about what you do.
No
And
problem.
depending on who's on the call, I might not really spend much time introducing ourselves because I think it's going to be mostly people that already know me. So
Okay.
we did not have as many people register for this as we usually do, so I apologize for that because usually we have a bigger turnout. So maybe the week before Halloween is busy for everybody. I don't know.
It's a busy time for everybody right now. You know, everything is complicated. This whole year has been unusual and challenging in a lot of ways.
Yes, it has.
Absolutely.
Actually, I was on Zoom meetings all day yesterday from 10 in the morning till 4 o'clock.
Ugh,
And it was like, oh my God. It was a
exhausting.
lot. So there are a lot of Zoom meetings going on right now.
Yeah.
Yep.
Wow.
Well, Nancy, do you want to introduce yourself? Because I know I have a few people from my team on here, but you want to introduce yourself and share about your business?
Oh, absolutely. My name is Nancy Hernandez Johnson. My husband and I own a business called AV Calibrations. We're an audio video integration company. So basically what we do is we handle all low voltage wiring, anything to do with AV, like your conference room, your large TVs with the sound system, the controlled lighting, the video cameras for teleconferencing. We can integrate everything into an iPad and where you can control it. We do alarms, cameras, again, anything audio video.
Thank you for sharing.
Nice to meet you all.
Nice to meet you.
Me too.
Well, we have quite a few. A lot of times people will eat their lunch while they're listening, so they'll keep their cameras off. So we have a few other people on just with
That's fine.
their cameras off. But I think with that, it's 12:03. So my name is Shannon Badger. Mostly everybody on this call, I think, knows me. But I'm a partner at Badger CPA firm, and we work with businesses in the San Antonio and surrounding areas. And our primary goal is just to bring them resources to help them be successful. And Michael Mewborne is a wonderful friend and also our financial advisor personally. And so we just trust him completely, and we wanted to give him the opportunity to share with our clients and our team just a little bit about himself, and then bring us some great information about the current market. So Michael, if you want to jump in.
Sure, absolutely. Thank you, Shannon. Thank you, Amanda. I appreciate having the opportunity to be here. It's a very unusual time, as we just determined about a minute ago. We're going to talk about weathering market volatility just a little bit, and then I'm going to open up the conference call to some questions, and hopefully I can, shed a little bit of light on what's on people's minds. My partner, Catherine Morrison, is also here on the call. So if there's something that she is more appropriate addressing, I'm gonna call on her, bring her in to help me out with answering some questions. We're a partnership at Wells Fargo Advisors located in San Antonio. The address of our location is 9311 San Pedro Avenue in San Antonio. Everybody can reach me on my work number, which is 210-377-7761, or my email address, which is michael.newborn@wellsfargoadvisors.com. We're going to talk about weathering market volatility in just a couple of minutes. I'm admitting 2 other people that are joining right now, by the way. I'm going to share my screen in just 1 second, but before that, I just wanted to go over a couple of quick notes. Oh, by the way, Shannon, thank you. You and Jonathan, thank you for letting me and Catherine be here and talk to your friends. I appreciate that. The 2 big takeaways I think that you're going to walk away with from today, and hopefully I'll only talk for about 20 minutes before we start opening it up to discussion, is volatility is normal. What we are experiencing right now with the Dow down 950 points yesterday and the Dow bouncing up and down today, that's normal. And in this particular environment here where there's a heightened amount of volatility, I think that most advisors would recommend that people just hold tight, you know, don't make any drastic decisions based on information that we don't have yet. You know, Catherine and I like to provide as much information to the people that we work with and the businesses that we work with as we can, so that they can make an informed decision about their money, their finances, their immediate future, and more importantly, their long-term future, their long-term goals. So stay invested, hold tight. You know, there's a adage out there that says it's not the market timing that's important, but it's the amount of time in the market that's important. If you try and do we'll talk a little bit more about market timing in a minute, but if you try and do market timing, that's not really a recipe for success for the most part. Our agenda today is to explore the answer to the question of how to weather market volatility. We're going to talk a little bit about what's happening now. We're going to talk about investment personalities briefly. We'll do a primer on asset classes, cash versus bonds versus stocks. We'll look at a couple of allocation examples. And then we'll talk about wealth building strategies. And that's going to help us answer that question of how to weather the market volatility right now. And then after that, I'll open it up to questions. So with that, I'm going to share my screen unless somebody has some pressing question that they need answered right now. And there are 2 more people that are trying to log in, so I'm going to admit them as we go. And please forgive me for kind of being distracted and looking away at the participants every once in a while, but I just want to make sure that everybody who wants to participate has the opportunity to do so. So, Amanda, be my litmus test. Can you see the screen here that says weather volatility?
Yes, it looks perfect. Yep.
Great. Okay. And at the bottom, you'll see my direct number, 210-377-7761, and my email address, wfa.com is the shortened version of it. If you want to reach Catherine, you can just email me as well or call me as well, and I can get you through to her if that's what you want to do. So with that, here we go. I actually want to start on a different slide. I don't want to start on the first slide. I'm going to skip all the way forward to slide number 24. This gives you an idea of what we're doing here. And then we're going to go back to the beginning. This slide here shows basically the fact that bear markets are really not unusual at all. You know, this slideshow shows you that they've occurred basically every 6 years on average since 1950. You know, this goes from 1964 all the way through to 2019. But historically, markets have recovered and gone on to reach new highs, as you can see on this graph. It's really very hard to it's really hard to get a sense of what things are what's happening when you're so close to it. You know, when you feel a 900-point drop like what we felt yesterday, that was probably rattling for a lot of people. There are a lot of disruptive forces out there in the environment that are contributing to what we're feeling right now, such as geopolitical crises, you know, potential terrorist attacks, recessions like the one that we felt earlier in the year, epidemics like we're feeling right now, consequential central bank policies, such as what the central bank did back in March in response to the COVID crisis that we're dealing with, those are going to be the things that are going to add to volatility. And right now is it's not a unique time in history. So if I take this back to slide number 2, now we can get going with how to deal with it, because that's the ultimate question that we want to answer today. Volatility is normal, just like I said. Bear markets, you're going to get one roughly every 6 years. Of course, past performance is no guarantee of future results, but historically, as that other chart suggests, the market tends to recover and go on to new highs. Another adage that I remember from a long time ago is the declines are temporary, and the advances for the most part are permanent. The overarching message that I had at the beginning of this presentation is to stay invested and hold tight, because getting out of the market before a downturn begins is actually really difficult to do, because you don't know when that downturn's actually going to happen. We felt the downturn yesterday, but maybe that's just the beginning of something more. Or maybe the end of the day yesterday was the bottom. We just don't know. It's very difficult to do. And so you want to just keep that in mind when you experience volatility, because you don't want to make a mistake and get out of the market at the wrong time or get into the market at the wrong time. The much stronger position that Catherine and I believe people should be in is to be in the market, stay in the market, and dollar cost average yourself into the market based on your investment objectives, your time horizon, and your risk tolerance, which we're going to talk about in just a second. So we've talked a little bit about what's happening now. If you guys have any more questions about what's happening now, I'm happy to try to answer them, but to be honest, there's not, nobody really knows what's going to happen in 5 days with this election. Everybody's going to have their own opinion on what's going to happen. A lot of people think that the results of the election are going to impact the market one way or the other. Historically speaking, they kind of don't. The market is going to be much more impacted by the economy and whether or not the country decides to shut down again. So I think those are the things that are more important to pay attention to. We're going to experience volatility because of the election itself, but there's no reason to think that it's doom and gloom. Moving on to the next screen, how do we respond to volatility? Well, we're going to look at some strategies on how to do that I believe that everybody should consider. And if you do this, you're going to be well on your way to being a prudent and long-term investor. First thing you need to do in order to answer that question of how to weather market volatility is to ask yourself, where am I? Assess your current situation, gather the information that you need to be able to answer that question, and then develop a strategy based on all the information that you gather. How are your assets allocated across all of those major asset classes that we're going to talk about? Cash, stocks, bonds. Are you diversified across different sectors? How much short-term debt do you have? How much long-term debt do you have? The goal is to gather all this information before you start developing an investment strategy. And if you already have an investment strategy, now's the time to reevaluate that strategy to find out if you're still on target. So now we're going to talk about your investment personality. This is how we determine how you're going to be able to weather the volatility that we're experiencing right now. Your investment personality is made up of 3 basic things. It's your investment objective, your risk tolerance, and your time horizon. And why are we doing this? Obviously, we want to retire comfortably. Maybe we want to send our grandkids to college. Maybe we want to benefit our charities that we enjoy. These are your objectives. They're nothing more than your reason why you want to invest your money. I like to say that money is a tool that you use to get yourself the things that you want in life. It might seem pointless to ask that question, because the obvious answer is we all invest because we want to make money. But really, I want everybody to get more specific when they're evaluating their portfolios, I want you to ask yourself, what is the money going to be used for? You know, the more specific that you can be in defining your objectives, the better off you tend to be in meeting or exceeding those objectives. You know, and there are plenty of examples of why you want to invest or how you want to invest, but that's really the subject of a different discussion. Right now, we're talking about how are we going to invest in order to deal with the market volatility that we're experiencing now. One of three, the first one of three is your risk tolerance, is determining your risk tolerance. Assessing this might be the most important step actually in determining your investment personality. You know, you need to ask yourself things like, do you want a more stable portfolio? Do you think of yourself as a risk taker? You know, are you willing to take some risks, but you're still uncomfortable with, you know, like swinging for the fences? That's what we talk about when we're talking about your risk tolerance. Sorry, this is the second of three. The first of three, going back, is your investment objective, is why you're investing. What do you want to use this tool known as money? What do you want to use it for? Here, we're talking about your risk tolerance. You wake up in the morning and the market is down another 10%. How are you going to feel? Are you going to be okay with that? Risk tolerance and investment objective have a lot to do with your time horizon, which is how much time is going to pass between now and when you want to meet your investment objectives. This also helps you determine how you want your assets to be allocated. And we're going to go through a couple of examples of asset allocation in just a minute. But if you're saving for retirement, you might have 20, 30 years left. If you are already in retirement, your time horizon is a whole lot shorter. That's going to affect the way you invest. So those three things, your investment objective, your time horizon, and your risk tolerance, make up your investment personality. And that all leads you to helping you determine how do you deal with market volatility. You know, if you are in retirement, you're going to deal with market volatility differently than if you are 25 years old, embarking on your career and, you know, willing to go through the ups and downs for the next 30 years before you reach retirement. So next, we're going to look at a few different asset allocation models. I'll quickly go through these for time purposes. This is a basic moderate growth and income investment objective. And you'll see the orange portion of the slide, that's equities, which in other words is stocks. The 16% portion, which is the hot pink or purple or fuchsia, however your screen is displaying it, that's your fixed income sleeve. And then real assets is about 7%, and then cash alternatives is 2%. We'll talk about all of these asset classes in just a minute, but this is an example of making a decision on what your objective is based on your investment personality. Here's another example of what your asset allocation might look like if you have an emphasis on long-term growth. If you're a younger investor and looking more for growth than income. And here's another example of somebody who might have more of an emphasis on retirement. You know, the point here is not to suggest which model is appropriate for which person. It's just to show you that any of these models might be right for you, and they might change. This model might be right for you now, and it might change to one of the more aggressive models 6 months down the road based on your particular circumstances. I just want you to see how the assets in each of these models, regardless of your particular objectives, can possibly be allocated. And the point is, if your portfolio is not properly allocated based on what you want across a variety of these asset classes, you probably have a little bit of work to do to try and get it back in the shape that you want it to be in. So next, we're going to do a little primer on asset classes. We're going to talk about stocks and bonds and cash, just real briefly. Starting with cash first. Cash is something that you can stick in a paper bag. It's something that you can take out of your bank account or your savings account quickly if you need it. And again, this all leads up to how are we going to deal with the volatility that we're experiencing right now? Some people might not be concerned about the volatility that we're experiencing right now, so they don't need to hold a bunch of cash off to the side. There are going to be times when investors favor having cash in their pocket or in their bank account. You might have some short-term goals like remodeling your home, buying Christmas presents for people, birthday gifts, holiday gifts. You know, you might want to hold cash in order to be able to take advantage of these opportunities in the market that are presenting themselves right now. And also, it's really important for you to hold, you know, every model that you look at is going to have a small sleeve allocated to cash. It's important to hold enough cash in your emergency fund or savings account, whatever it is that you want to call it, to cover somewhere between 3 and 6 months worth of your family's expenses. Perhaps starting in February and March of this year up to the present would be the most, you know, visceral example of why that's important. You know, we saw 30 million people lose their jobs in the course of 4 weeks. And slowly we are recovering those jobs. But for all those people that suddenly found themselves out of work, if they didn't have an emergency fund to fall back on, they probably would have felt even more stress than they felt with having just lost their job. And where are we now? You know, from March to October, almost November now, we're 7 months into this thing. And so if you have 6 months worth of family's living expenses stored away somewhere in cash, that's definitely going to help you weather market volatility. Obviously, it's silly to say, well, you should have done that 7 months ago. But, you know, for the future, once we find our way out of this particular situation, if you don't have an emergency fund set up, it would be very valuable for you to set one up and contribute to it courageously and consistently, you know, whatever you can afford to contribute, and make it a goal that you have somewhere between 3 and 6 months worth of living expenses in that account. Now we'll talk about bonds real briefly. This is still part of asset allocation. And once again, the goal here is to figure out how we're going to weather the market volatility. Owning bonds has a couple of important reasons. There's a couple of good reasons why you want to hold bonds. They tend to behave a little bit differently from stocks. You know, if a stock zigs, the bond is going to zag in general. Sometimes they'll move in correlation with each other, but for the most part, you'll see the bond market increase in value if the stock market decreases in value. Again, that doesn't always happen, but that's a pretty common observation that people see. Bond prices are generally less volatile than stock prices. So if you're a more conservative investor, you might want to consider having a larger allocation to bonds in your portfolio than to stocks. Bonds also have specific maturity dates, and so that might be useful for planning specific future expenses that you're expecting, such as retirement or a child going to college or something like that. You could spend a ton of time talking about bonds and stocks and cash, but I don't want to spend all that time here because I want to get through this and open myself up to people for questions. This slide talks about stock diversification. And really what I'm getting at here is stocks and equities. The first thing to remember when you're buying stock is the need to diversify across all different sectors and investment styles. Most people know that owning stock means that you own a portion of a company. You are an investor in a company. And that can be a very volatile investment because some companies are run very well and some companies are not run so well. And I'm talking about publicly traded companies. It's difficult. Owning stock in a privately held company is a totally different discussion. But in this instance here, if we were looking at a portfolio of a person that has only stocks here, my question for everybody is this person diversified? Is she diversified? She's got 1, 2, 3, 4, 5 different sectors being represented in her portfolio. But as you can see, look at the pie chart. She thinks she's diversified because she owns 5 different sectors, but she's very heavily concentrated in one particular sector, the financial sector. And that is an important thing to identify when you are gathering all of your information and assessing what you have and where it's allocated for purposes of being able to weather market volatility. I can see a situation such as the one that we're in now, where somebody who's invested in financials might see their portfolio decrease in value pretty substantially because the Fed, which is a part of the government that makes decisions on interest rates, decides to lower interest rates to basically zero, like they did in March. In this instance, somebody who's got 42% of their portfolio in financials might find themselves in a bit of a pickle. So this is the reason why asset allocation is important. Delving into your portfolio to find out what your actual asset allocation is in order to help you weather market volatility in a manner that you're comfortable weathering it is so important. Now I'm going to talk really briefly about investment styles. You can, for stock purposes, you can have what's known as a value investing bent or a growth investing bent. They tend to complement each other over time. I think that it's valuable to consider having both of those represented in your portfolio. It's just another aspect of diversification. This is a quilt chart that I'm not going to spend any time talking about because it's just kind of overkill talking about diversification across a lot of different sectors and a lot of different styles. I want to move on to wealth building strategies now. There are 3 of them listed here on this slide, but I actually think there are 5 strategies that are important to remember. The first one is use systematic investing, which is dollar cost averaging. The second one is stay in the market, which is really my overarching theme here, is hold tight, don't get too bent out of shape about the volatility that we're experiencing now. And the third one is think long term. That's a really good way to help weather market volatility, is to not think short term, because you might get whipsawed. The other 2 that I would add to this would be allocation, which we've talked about. I really think that that's key, is determining, what your investment objective is, what your risk tolerance is, what your time horizon is, and then based on that personality, allocate yourself in a way that's going to make you comfortable. And then the last of these wealth building strategies that I would add to is review that portfolio regularly, once a year at least, maybe more frequently if you think you need to. Systematic investing is also known as dollar cost averaging. And this is a really powerful way to get yourself exposed to the market when you don't really know what to do. You don't know how to deal with the market volatility. Catherine and I recommend this strategy a lot. And with dollar cost averaging, what you do is you make a commitment to investing a fixed dollar amount periodically, consistently and courageously, whether that's monthly or quarterly or some other time period. And you do it no matter what the market is doing. So it's regardless, it's irrespective of the market volatility. When you do that, when share prices are down, you end up buying more shares of whatever it is that you've chosen to buy. And when the per share prices are up, you expose yourself to less of those higher share prices because you purchase fewer shares. And the key to doing systematic investing or dollar cost averaging is to actually pay yourself first. You want to invest that money for yourself right away. Don't wait until the end of that period to see if you have enough money to do it, or if you need to adjust your funds that you have left over in order to make those investments. You want to, if you're serious about long-term investing, weathering market volatility and setting yourself up for success in the future, it's really important for you to pay yourself first if you want to meet those goals. This is an important piece. It talks a little bit about market timing. It just reiterates my message, which is stay in the market. You know, this chart shows the effect on somebody who's invested from 1990 until the present. And if they miss the best 10 days of the market, their portfolio price return is down about, you know, almost 300 basis points. And if you miss the best 20 days, you miss the best 30 days, your performance goes down commensurately with that. Again, it's not market timing. It's the time in the market that has the best chances of bringing about long-term success for you. Here's that slide again that I started off with. I really do think this is an important slide. This chart goes from 1965 to 2019, like I talked about at the beginning. The longer the holding period that you have for yourself, the less of a risk that there is going to be in you losing your invested principal, and the less important that short-term volatility that we're talking about becomes for you. In other words, if you have a short-term time horizon, volatility is going to scare you. And if you have a long-term time horizon, volatility is not going to scare you very much, because you know you have more time to recover and experience that upward trend that the market tends to have. It's hard. Emotions get in the way. You know, holding your positions for a long time can definitely be a challenge. Logically, I think most people understand and accept that markets rise and fall, but emotionally, some people just can't ride that wave when they need to. You know, yesterday was a somewhat scary day, and you know, I'm sure there were some people out there that called their advisors and expressed that emotion to them. But if you can develop the discipline and the patience to shrug off those market fluctuations, you're going to be much better off, in my opinion. Watch your asset allocation. This is all part of revisiting your portfolio on a regular basis. Before we stop talking and I accept your questions to answer, just keep an eye on your overall asset allocation. That's the message that I want to get to you here. In this particular slide, you see 50% fixed income, 45% equities. And let's say that this is an allocation that you think is right for you. But 6 months from now, you take a look at your portfolio again and you realize that there's been a whole lot of activity in the bond market, and suddenly you find yourself heavily allocated to bonds, 65%. That eats away a little bit at your equities position. You might want to work with somebody to help you develop a strategy to get your asset allocation back in line. There are a lot of different ways that you can fix that. And there are tax consequences to some of those solutions, and that's where Shannon comes into play, where she can help you figure out, you know, what is the right move for you. And ideally what you do is you have Shannon working in conjunction with whoever your financial advisor is to help you make the most prudent decision with your asset allocation based on what your particular goals are. So with that, you know, you might be asking yourself, what can you do today? And the answer is, going back to what we talked about at the very beginning, assess your situation, figure out what kind of an investor you are, figure out what you already have, how it's allocated, and then go talk to somebody. Set up an appointment with someone to try and put yourself on a track that you're comfortable with. Catherine and I are always available to talk to people. Again, I can put my information up on the screen again, or you can get that information from Shannon, or Jonathan, or Amanda, or Christy if you need to. I don't know how much more to say about asset allocation, I feel like I've beaten that dead horse, but the gist is we need to think about those longer term goals in terms of how to weather market volatility. And I think that if you focus on those very simple long-term goals that we talked about at the beginning, think long-term, stay invested, dollar cost average, pay attention to your asset allocation, and review your portfolio on a regular basis, I think that's probably a good recipe for success in weathering the market volatility that we're experiencing now. And by the way, we will continue to experience. So with that, I'm going to hand it back over to Shannon and see if she has any questions or comments before we open it up for questions.
One comment I just wanted to make is that planning is really important, and having a rhythm of reviewing your plan. I know a lot of people that have had, maybe you had different jobs before, you had a corporate job and you had a couple different jobs. And so you probably have retirement plans potentially at multiple places. But that kind of consolidating all of that into one place so that you can actively manage it is really important. And then also like reviewing your overall coverage for all your life insurance as well. And then also your investing strategy, because honestly, like your goals every year shift. And so if you just set something in place and forget about it, 5 years down the road, like what you're, doing might not be in alignment of your goals anymore. So, us personally, we meet on this at least once a year, if not more often. And so I just wanted to encourage people to do that, because I know a lot of people kind of set it and forget it, and then they don't look at it for years and years. So it'll be like, oh, surprise, we have another kid, or something major happened and our retirement timeline has moved up or down. And so I think it affects all of your asset allocation and the things you should be doing. So that's my only side note.
And if I could add to that, Shannon, Catherine and I do, Catherine more so than me, but we both spend a lot of time talking to the people that we work with about, end of the year planning, tax loss harvesting, gifting strategies, reviewing your insurance. Right now, between October and December is a really good opportunity for people to put it at the top of their mind, because there is a deadline. 12/31 of every year is a strong, hard deadline for several of these different strategies. Shannon is well aware of the tax implications for a lot of those deadlines. So now's a good time of year to be thinking about things like this. The volatility brings to mind a lot of different goals that need to be revisited. Does anybody have any questions?
One thing I thought was interesting from the chart was that it feels like it's been very volatile lately, but when you see it in the chart and the overall look of things, it's like compared to what we've been through in the last decade, it's really visually, you can see it's not really as bad as it kind of feels. Because a lot of us were around in 08 and 09 and all that. And so I thought that was, encouraging to see.
Yeah, but we have definitely experienced what's known as a bull market with several little panic attacks from 2009 up into the present. The question is, will that upward trajectory continue unabated, or are we going to have a major contraction which leads to what is known as a bear market for a while before it turns back around? And the answer is, we don't know. But if you if you stick to your guns, stay invested, stay the course, develop a strategy, develop a strategy based on your objectives. Not everybody's going to have the same strategy, and stick to it. That's going to maximize your chances of success in the long run, meeting those goals.
Absolutely.
Questions?
I do. I have a question.
Sure.
Well, and I would like to start off by saying, as a business owner, I think investment in your long-term, retirement goals is so important. I offer a simple IRA to my employees. It's not a 401k, it's a lot smaller, but that's what we can afford right now. And we're pretty small. One of my employees, because of the way the market is, she decided to stop investing. She didn't close out her account, but she stopped the continuous withdrawal and input into her account. And I tried to convince her not to, but then I rethought about it, and I'm like, I better not, because if anything happens to the market, she's going to come back and tell me, well, you told me to do this, and I'm not a financial investor, but I did feel it was important to stay in it, even if you're contributing a small amount. So part of what you said was to continue investing into your account. Did that mean on top of your simple IRA that I have right now, should I go and invest more money, put more cash money into it right now that the stocks and shares are lower? Is that what you meant?
Well, yes and no. I mean, anybody's decision to invest is going to be a personal decision. I think your question is, over and above your simple IRA, which you are currently contributing to, should you invest more?
Right.
And the answer to that question is going to be very personal. It's
Okay.
going to be based on your own individual situation, your own cash flow needs, your own long-term objectives. What I meant when I was expressing my feelings about investing in general is you want to pick a strategy, and you want to stay consistent with it on that regular basis. When I work with people, most of them typically want to invest consistently on a monthly basis. So I'll use in a 401k or a simple IRA. Those are good examples of investing consistently on a regular basis, because usually if somebody's contributing to a 401k, they're taking a little bit out of their paycheck and they're deferring it into their 401k bucket every pay period, courageously and consistently, and they don't change it. Another example of doing that is, I'll use myself. I have 2 kids, and each kid has a 529 college education plan. And I like to tell people that if you invest, $100 a month into that 529 plan, you're going to get stronger, more consistent results in terms of the dollar cost averaging of those things. Because if the market's up, you're going to buy fewer shares. If the market's down in that month, on the day that you invested, you're going to actually buy more shares. You're going to get a stronger bang for your buck. That's what I meant when I said keep investing courageously and consistently. Okay. I wasn't necessarily saying the market's down
now that the market's low.
Not, everybody's different, and
okay.
So please don't take it to think that
Okay, I got it.
take advantage of this time.
Yeah.
Yeah, I don't want to encourage people to be reckless. Does anybody else have a question?
I do. Michael, is this a good time to be investing in the mutual funds? Because I noticed I'm very heavily invested there. I'm like at 65, almost 66% on mutual funds. Mm-hmm. Whereas in stocks, or I guess the stocks, I'm at 31, almost 32%.
That's a great question. And that actually leads me to another thing that Catherine and I really enjoy doing, which is educating people on the different types of investment options that there are out there. It's really important for people to understand what they have and how those things work with each other. So to answer your question, I'll tell you this. A mutual fund is actually a basket of stocks and bonds and cash. So if you own a mutual fund, what you own is a sliver of that basket. By contrast, if you own shares of Exxon stock, for example, you own a portion of the company. And mutual funds are great because they help you, they force you to be diversified in what you're investing in. So you put $1,000 in a mutual fund, and that fund might own 110 different securities. Well, now you're automatically diversified across all 110 of those securities. And if one of those companies tanks, goes bankrupt, or one of those bond issuers defaults for some reason, you've only been hurt by one of the 110 that are in that basket.
Okay.
So I do think that mutual funds are a really good way for people to invest in a diversified way. Obviously, there are risks associated with mutual funds, just like there are with stocks. And anybody who has more questions about that, feel free to reach out to me or talk to Shannon about it afterwards, because she's also very knowledgeable about how mutual funds work, particularly the tax implications on mutual funds.
Okay.
And I think it's important to reiterate, mutual funds are a way to invest across all different kinds of classes. There are stock mutual funds, there are bond mutual funds, there are real estate mutual funds, and then there's some mutual funds that invest their fund across all those different classes. So when you say you're 60% mutual funds, that still wouldn't be able to tell us if it was a stock fund or a bond fund unless we dig down into which kind of funds you have. So,
That's a really good point, Catherine. Yeah, thank you.
mhm.
Does anybody else have any questions about market volatility, what we're experiencing now? Thoughts, concerns?
I don't really, but you hit on this once already, but like the market timing, like we have had people where it's like when, some news comes out, then they go buy low and then they try to sell high. And it's like that. My printer just decided to update when I was talking. Sorry. And it's like, that might be fun, but it's almost like, let's say like gambling, for lack of a better word. So it's like, you might be able to time some things and it might work in your favor a few times, but like Michael said, that's really not, an overall long-term strategy. And so we always tell people, like, don't plan on this, like, I'm going to buy low and then I'm going to exit high and then I'm going to try to do it again. Yes, some people do that, but I really wouldn't recommend it.
That's also a very good point. Buy low, sell high. It's a great adage. That requires, that's called market timing. And that requires that you are correct twice. It requires that you're correct when to buy it. And it also requires that you're correct when to sell it. And it's hard to be right, perfectly right once. It also, doing the buy low, sell high type of market timing strategy also takes a lot of time and a lot of effort and a lot of discipline. Sitting at your computer or sitting in front of a television screen and just watching. And everybody on this call is a business professional, and you're focusing your energy on building your own business, building your own brand. If you're focusing your time on trying to time the market, you might be doing yourself a bit of a disservice in your own personal goals.
Yeah, I would agree with that. But I don't have any other questions. Anybody else?
No.
Thank you, Michael, for your time. And Catherine, we appreciate you all joining us and just your partnership and friendship. And we just appreciate you taking the time to spend with us. And I want to be sensitive to everyone's time and everyone's busy. So if no one has any other questions, then we'll end a little bit early.
Okay. Thank you for your
so
time.
much. We appreciate it.
Thank you all very much for your time.
Thank you, everyone.
Thank you,
have a great
Michael.
day.
Take care.
Bye-bye.
Bye-bye.